So what is the total shareholder value that one can expect? In order to get this figure, you want to take the dividend yield and add that to the average increase in earnings for the last 5 years. These two amounts together give you the total shareholder return you can expect. So example, a dividend yield of 1% plus an average increase in earnings of 9% for the last 5 years. This gives us 10% as the return we would expect the entity to provide. How do you receive this 10% return? It's not like a bank where you just get the 10% interest paid into your account. Assuming we had a company with a 1% dividend yield and an average earnings increase of 9%, you as an investor in this company would receive 1% of the price you paid for the company as a dividend. That's the dividend yield, right? And if the earnings had increased by the historical average of 9%, then the share price should also increase by 9%. Remember, the share price follows the increase in earnings. It is that simple. It is important to assess this value after a diligent appraisal of the business and its future has been conducted. The 5-year average increase in net income acts as a guide to the future, but an assessment of the business is necessary in order to determine if we can expect this amount of growth to continue. Please remember that. As an example, let's assume the share price of a company is $10 per share. You buy 10 shares and therefore you have spent $100. During the year, you will receive a dividend yield of 1%, which translates into $1. The total amount you spent on the shares multiplied by the dividend yield of 1%. $100 multiplied by 1%. Then, once the year has gone by, the company managed to increase the earnings in line with the historical average of 9%. Consequently, during the year, the price of the shares has increased by approximately 9%, i.e. one share is now worth $10.90. We then have to go ahead and multiply this by the 10 shares you purchased. This means that the current value of all your 10 shares are $109. Okay, so it's 10 shares multiplied by the current share price of approximately $10.90. Therefore, in total for the year, you received $1 in a dividend, and you also received $9 in capital appreciation. Remember, the difference in the share price at the beginning and the end of the year is your capital appreciation. When we initially purchased these shares, it was for $100, and the value at the end was $109. So that gives us $9 as the capital appreciation portion. So take the $1 plus the $9, this equals $10. $10 divided by the original investment of $100 gives us 10%. And what do you know? The return on the investment is equal to the dividend yield plus the expected increase in earnings. So let's briefly bring it all together. You now know how to identify a cheap company from an expensive company. You also now know how to determine the value you would expect to receive from investing in the company. As a value investor, you quite simply want to minimize the price you pay for the company. You should be thinking of your price to earnings ratio here. And then you want to maximize the return the company provides to you. You should be thinking of your dividend yield plus your increase in earnings for the last 5 years.